Okay, so we worked through the net income for our manufacturing company. Welcome to video 3 here for Chapter 10 homework. Next up we have the balance sheet for this manufacturing company. So let us begin building that balance sheet by starting with our cash again. So again, we can go to our cash activity, see that our cash started at 0. It was increased by the sale of our common shares. It was increased by our cash revenue, and it was reduced by our cash payments. So still that $51,000 in cash that all the other companies had as well. Our finished goods inventory, we calculated that above as we were looking at our units that we started and completed, the units that we sold, and the units that we still had on hand. So our finished goods inventory, this 1,290, is what we calculated back in video 2. Our manufacturing equipment, let's go up here and find out what the cost of that equipment was. So our manufacturing equipment cost $20,500. That's what we paid for it. That's our historical cost. Our accumulated depreciation after 1 year, this $4,600 that we calculated back in video 2, that's our accumulated depreciation. That's the depreciation that 1 year of using that asset. That's with the accumulated depreciation. So our total assets then are going to be the sum of those items that we just outlined. Our cash, our finished goods, our equipment minus our depreciation. So we have total assets of $68,190. Let's go to our liabilities and equity, and let's see what we end up with here. Still, we have no liabilities. We have no debt. We have no borrowing that we owe to any outside company. Our common stock, we still have the same 32,000. Yeah, 32,000 in common shares that we sold to our shareholders. Our retained earnings, again, it began with nothing. We're going to add our net income that we calculated on our income statement, and we're going to subtract nothing because we paid no dividends. If we look to our balance sheet for our total liabilities plus our equity made up of our common stock and our retained earnings, I hope this comes to $68,190, and it does. Very good. So our balance sheet is in balance. Our total liabilities and equity agrees to our total assets. So we are good to go with question number 4. So let's move on then to question number 5. Okay, so for question number 5, we have several transactions that we need to account for into the framework like we did in class. Let's see, last week I think we went through those types of transactions. So what I've done is I've taken the transactions and kind of just built them out into this spreadsheet so we could go over them. You can see when we purchased the administrative equipment here for $177,000, I've populated our spreadsheet with the salvage value as well as the useful life for the manufacturing equipment as well. So what we needed to look at was we have our framework, our accounting framework with our accounting equation, our assets over here on the left. We have no liabilities, so there's nothing here. And then our common stock and our retained earnings making up our equity. So as we look at each of these transactions, we'll use this framework again to record those transactions. I've kind of tried to get it to fit onto one page for this video, so I hope that's not problematic for you and that this is coming through okay for you. as you read it. So, oh, sorry about that. All right. So, the first transaction we paid $29,000 of research and development costs. Okay, research and development costs. Remember, those are what we would call they're product costs because they don't relate to the actual manufacturing process. Okay, we research, we develop, we research, we develop. Maybe we produce, maybe we don't. Okay, so this science behind coming up with new products, it's a period cost. It's you remember the upstream, midstream, downstream, right? We're talking about the upstream costs here. Our product costs are going to be in that midstream category, that one slide that we had from chapter 10. So here we're talking about upstream activities. So we paid cash for some expenses is basically what we're then saying. So we're going to subtract from our cash account. Let me quickly reformat these numbers for ease. Okay, let's keep going. So we decided that this was basically a period cost. So our cash is going to be reduced whenever we have an expense, a period cost. We're going to also reduce our retained earnings, and that is going to be an expense, $29,000. Okay, second transaction, we paid $53,000 for raw materials. So we paid, so our cash is going down and our raw materials is going up. That's what we used that money for. We purchased some raw materials. So our inventory is going to go up for our raw materials category. Item 3, we placed $84,000 of raw materials into process. So we're going to subtract $84,000 from our raw materials and increase our work in process. Just a shift of that inventory, moving it from raw materials into in process. We took it out of the storage facility and we put it in process. Transaction 4, we paid $64,000 for salaries of our selling and administrative employees. So we paid cash for an expense for our selling and administrative folks. So that would be a period cost. So it's going to also reduce our retained earnings, just like our research and development costs. And again, our expenses are going up by $64,000. Okay, transaction 5, paid $106,000 for production workers. So we paid $106,000 for production wages. Our cash is going to be coming down because we paid those wages, and our work in process is going to increase because that's a cost. It's a conversion cost. It's a product cost, and we account for those in that work in process category. So $106,000 is going to be increased within that work in process. So transaction 6, we paid $177,000 to purchase equipment used in admin offices. So we paid cash. So our cash is going to come down for the grand total, and our office furniture and equipment is going to be going up. That's what we use that money for. Okay. I've been neglecting our cash flow impact. So let's go back and walk through those here. So this first transaction, $29,000 cash flow. This was for an operating expense, so it's an operating activity. This second transaction, $53,000. That was for raw materials. Again, that's an operating activity. We're buying those from our from key vendors and suppliers, something we do every day. No cash involved with this next transaction, so that's an NA. Transaction 4, negative 64,000. That was again for the selling and administrative folks. So again, we deal with our employees every day. That's an operating activity. 106 for our production employees. Still an operating activity because we're still dealing with employees. We're production versus admin. They're all still employees. This 177,000 that we just spent in this transaction, the sixth transaction, that was for that office furniture. Those are for long-term assets. Those are for long-lived assets. So there we're going to have an investing activity. Okay, so transaction 7. We recognize depreciation on the office equipment. Okay, so the office equipment, the administrative equipment, we already captured that there was 17,000 in salvage value and an 8-year useful life. Hopefully at this point, after the other exercises, the calculations for depreciation are all coming back from survey. We're going to take the cost, we're going to subtract the salvage value, and we're going to divide that balance that's left by the useful life. So for our admin equipment, we have $20,000 in depreciation that we're going to use every year. So in this framework, we don't have a column for accumulated depreciation, so we'll simply just show that reduction here in the office furniture column and show that expense, that 20,000 in depreciation expense as a reduction in our retained earnings. And again, depreciation not a cash expense, so no cash flow impact. All right. Transaction 8. We paid $128,000 to purchase that manufacturing equipment. So $128,000 that we paid for the equipment. Our manufacturing equipment is going to go up. That asset account that shows the ownership of that equipment. Our statement of cash flow impact, $128,000 going down, and again an investing activity. We're making the purchase of that long-term asset. Transaction number 9, we're going to recognize the depreciation on that equipment. Again, we have a salvage value of $29,000, a 9-year useful life. So again, we'll take a look at the cost, subtract its salvage value, divide it by its useful life. To calculate that every year, we're going to have $11,000 in depreciation on that manufacturing equipment. So when we record that depreciation here in our 9th transaction, we will be increasing our work in process to show that overhead, right? That overhead coming into that process, into that conversion process, and our manufacturing equipment will be coming down by that accumulation of depreciation. Again, not a cash expense, so no statement of cash flow impact. Okay, transaction 10. We paid $52,000 for rent and utility costs for the manufacturing facility. So we paid cash for what? For utilities on the manufacturing facility. So because that relates to our manufacturing facility, that's also another form of overhead for that plant. So we're going to have $52,000 as an increase in our work in process. Okay, let's take another small break here in video 3, and the third key word for this video series, the third word is important. The third word is important. Please jot that down for your email.